Gold is down 4% on Tuesday, day 4 of war. That should not be happening. Something is breaking underneath the surface of this market, and it's not what you think. Hey, I'm Kirill Talai, investment analyst with over a decade of experience. Here we connect the dots between macro, crypto, and AI. No noise, just what actually matters for your portfolio. Today we've got 3 stories to cover. First, the Iran war. I warned you about this in our last episode. It is here. I walk you through the market reaction and where oil goes from here. But then, I'm going to show you why Iran might be just a sideshow, why the real risk is something hiding in plain sight that almost nobody is talking about. In our third story, while all of this is happening, something is being built that could replace the financial system as we know it. And it connects AI and crypto in a way I don't think most people understand yet. Let's get into that. But before we do, as always, quick disclaimer. Nothing on this channel is financial advice. I'm sharing my views and analysis, but always do your own research before making any investment decisions. Last episode, I said this. Let's start with what I think is the most underpriced risk in the markets right now. Iran. I said the build-up was massive, that nobody was paying attention, and that if strikes actually came, the sell-off would be sharper than history suggests, precisely because the risk hadn't been gradually absorbed. On February 27, the US and Israel launched coordinated strikes on Iran, Operation Epic Fury. The supreme leader killed, dozens of senior officials taking out, the largest US military operation since the 2003 Iraq invasion. But Iran hit back, harder than most expected, and not in the way anyone predicted. This wasn't a conventional military response, it was asymmetric. Drones hitting the US embassy in Riyadh, missiles striking energy targets across the Gulf, Arab Emirates, Kuwait, Bahrain, Qatar, Hezbollah opening a second front from Lebanon, Gulf airports shut down, flights cancelled across the region. And then the big one. Iran's Revolutionary Guard declared the Strait of Hormuz closed. About 20% of world's oil supply passes through that narrow channel, now blocked. Monday, the market tried the old playbook, sell the open, buy the dip, close flat. And it worked for one day. Tuesday, completely different story. New strikes, Hormuz closure confirmed, escalation everywhere. S&P down 2.5% at its low. Dow Jones down 1,200 points before recovering. Brent hit $85. Now, here's my read. Oil has probably made most of its move. Brent went from 67 to 85 in 4 days, a 27% jump. And the futures curve is already pricing this is temporary. The market is betting oil comes back down, not stays here. And I think that's probably right. Iranian leadership is decimated. The country is under enormous pressure. And crucially, the US has no rigid demands here. There is no line in the sand that prevents a diplomatic exit. Trump likes short, decisive wins. And there is a political incentive too. The administration is not going into midterms election in November with high gas prices. That's another reason to expect a resolution sooner rather than later. But if I'm wrong, if Hormuz stays closed for weeks, you're looking at $100 oil. And that changes everything. Inflation, rate expectations, risk assets across the board. Keep some dry powder. And I explain why in our next story. Because the reason for caution goes deeper than just oil. This episode is brought to you by Anderson, a global software development company building high-quality custom solutions for finance, healthcare, and beyond. Okay, so most people right now are going to tell you the market is selling off because of Iran. I think that's wrong, or at least it's only half the story. And the other half? That's actually the more important part. Something was already breaking before the fast missile launched. Let me start with that number from Tuesday, because I think it's the single most important data point of the week. Gold down 4%. Equities down. Even bonds, which are supposed to be the safe haven, are selling off. During a military conflict, That's not supposed to happen. When bombs are falling, investors run to safety. That's the whole point of these assets. So why is everything going down at once? One explanation. People are selling everything, even the stuff that's supposed to protect them, because they need cash. Not because they want to, because they have to. They are covering losses somewhere else. That's not a war trade. That's a margin call. That's what forced selling looks like. And if you've seen this movie before, March 2020 did the same thing for a few days, you know, it's a signal that something structural is happening. So let's talk about what that something is. Technology is the biggest sector in the stock market. Not by a little, by a lot. It's roughly 30% of the entire S&P 500, almost a third of the value of America's 500 biggest companies, sitting in one sector. And that sector has been getting crushed. The software ETF is down over 30% from its October highs. Worst month since the 2008 financial crisis. We covered this in our first episode. AI disruption is compressing software valuations. And it's spreading. Legal tech, insurance, cybersecurity, wealth management. Every week another industry gets hit. Now, here's the part most people are missing. And this is the key to understanding what's really happening. When a company's stock drops 30% and doesn't recover for months, it doesn't just hurt the people who own the shares. It weakens the company's entire financial position. Think of it like this. You buy a house for $1 million. You take out a loan for $700,000. Everything is fine. The bank is comfortable because your house is worth way more than what you owe. Now, the house drops 30% in value. It's worth $700,000. Suddenly, the bank's cushion is gone. The loan hasn't changed, but the safety margin has evaporated. And if the bank starts to worry, they can demand more collateral or call in the loan entirely. That's exactly what's happening across the software sector right now, but at massive scale. Over the past decade, a huge private lending industry grew up around tech. We're talking over $1.5 trillion in private credit, funds that made loans to software companies when valuations were at all-time highs. These weren't banks. These were private funds pitching investors on the idea that software grows forever. So these loans are basically bulletproof. Well, software isn't going forever anymore, and the cracks are starting to show. A few weeks ago, one of the biggest firms in this space, Blue Owl Capital, stopped letting investors take their money out. Investors were lining up to withdraw. In one fund, 15% of the total value was being demanded back in one single quarter. They had to sell $1.4 billion in loans just to raise cash. Their stock down 40% in 6 months. And it's not just them. Private equity firms have been falling for weeks. The question that's starting to circulate in the market is whether this is a canary in the coal mine moment for the entire private credit industry. Now, here's what makes all of this so confusing. The economy. It's actually fine. Manufacturing just expanded for the second month in a row, ISM at 52.4 in February. Jobs are solid. Inflation is still elevated but coming down. By every traditional measure, things look okay. And that's exactly what makes this moment so dangerous. Because the stress isn't coming from the economy, it's coming from a structural shift. AI is fundamentally changing which businesses have value and which don't. And the financial system that was built on top of the old assumptions, the lending, the leverage, the valuations, hasn't finished adjusting. Then the war starts. Oil spikes. Inflation expectations jump. The Fed can't cut rates as fast as everyone hoped. And all those positions that were already under pressure, they just got squeezed even harder. Iran didn't cause the fragility, it accelerated a deleveraging that was already underway. That's why gold, bonds, and equities are all falling at the same time. That's why Monday recovery didn't hold. And that's why I said, keep dry powder. in the first story. If the deleveraging thesis is right, the system needs time to digest it. This kind of structural repricing doesn't resolve in a week. Now, if the market drops 15 to 20% from the highs, that starts to look like a real entry point. But we're not there yet, and things could get worse before they get better. Okay guys, a quick aside. If this kind of analysis is useful, hit subscribe. We do this every week. Okay, back to it. Alright, so the picture so far is pretty bleak. Old financial structures cracking, forced selling, a war accelerating the stress. And here's the thing, and this is actually why I started this channel. While all of that is happening, something completely new is being built, quietly, in the background. And it connects the two things this channel is about, AI and crypto, in a way that I think most people haven't understood yet. Quick question. What do you think crypto is for? Well, most people would say speculation, trading, maybe digital gold, and honestly, that's been fair for most of crypto's history. But something is changing right now that I think will look obvious in hindsight. And it starts with a simple question. What happens when AI agents need to pay for things? We're moving into a world where autonomous AI systems, agents, do real economic work. Not just answer your questions, actually transact, buy compute, pay for data, move money, negotiate prices, all without a human touching anything, 24 hours a day. And this isn't theoretical anymore, it's happening right now. Last week, Jack Dorsey laid off 40% of Block's workforce, 4,000 people gone in a single day. He said AI tools have fundamentally changed what it means to build and run a company. Now, is some of that a cover for cleaning up overhiring? Maybe, even probably, but the stock surged 25% on the announcement. Wall Street loved it. That tells you something about where the market thinks this is heading. And Dorsey said something that stuck with me. He said most companies are late to this, and within the next year, the majority will reach the same conclusion. Meanwhile, the infrastructure for agents to transact is going in fast. Visa launched something called the Trust Agent Protocol. Hundreds of real AI-initiated transactions already completed. They're predicting millions by the 2026 holiday season. Mastercard rolled out Agent Pay to all US cardholders. Stripe and OpenAI published an open protocol for agentic commerce. PayPal, Santander, all building. This is not a startup experiment anymore. This is Visa and Mastercard telling you that the next era of commerce won't be humans clicking checkout buttons. It'll be agents doing it for them. And here's the problem. These agents need to pay for things, and the current system can't handle it. Banks batch payments. They settle during business hours. They are closed on weekends. They charge 30 cents plus 3% per transaction. If an AI agent needs to make a 2-cent payment for a piece of data, the fee literally costs 16 times more than the payment itself. The entire category of machine-to-machine commerce, which could be enormous, simply cannot exist on traditional financial rails. The pipes are too slow, too expensive, and too closed. This is where crypto stops being about speculation and starts being about plumbing. And the numbers already back this up. Stablecoins, digital dollars that live on blockchains and on networks. Stablecoins processed over $11 trillion in January alone. 11 trillion in 1 month. That's more than Mastercard processed in all of 2025. And the economy at the center of this? Circle, the issuer of USDC, the biggest regulated stablecoin. They just reported Q4 earnings last Tuesday. The numbers were extraordinary. Revenue up 77% year over year to 770 million. USD in circulation up 72%. On-chain transaction volume this is the big one, up 247% year over year, nearly 12 trillion in a single quarter. Adjusted EBITDA up 412%. But here's what caught my attention. On the earnings call, Circle CEO spent most of the time talking about the agentic economy, not stablecoins as a crypto thing, as infrastructure. He said, and I'm paraphrasing, Circle is building an economic operating system for the internet. Virtually all measured agentic payments today run on blockchains and USDC. Transaction cost? 100,000ths of a cent. Nothing else comes close. The market reaction tells you everything. Circle stock roughly doubled in 5 days after that report. Doubled. While the S&P 500 was falling, gold was selling off, and the Dow was down over 1,000 points. This is not just a random move. That's the market telling you where the next cycle of value creation is. And Congress is moving. The Genius Act gave stablecoins the first real legal framework. The Clarity Act, which defines who regulates what in crypto, passed the House and is being negotiated in the Senate now. The White House wants it done before midterms. For the first time, the US is treating crypto as infrastructure, not just speculation. Now, think about what this means at scale. Right now, maybe 5 million people actively use these networks. What happens when there are 40 billion autonomous AI agents? That's just 5 agents per person on Earth. Each one transacting 100 times more frequently than a human. The demand for fast, cheap, programmable money doesn't just grow, it explodes. And that's not a prediction about 2030. The building blocks exist today. So what does this kind of new financial system actually look like? Think of it in 3 layers. The first layer is stablecoin, digital dollars. They are the working currency. When an AI agent pays for data, buys compute, settles a contract, it pays in stablecoins. Fast, cheap, programmable. There is the thing, stablecoins are still government money. They're backed by treasuries, they're the dollar, just on different rails. The second layer is the blockchains themselves, the rails. Solana, Ethereum, and a few others. These are the networks that actually process the transactions. Think of them like Visa or Mastercard, except they run 24/7 and cost almost nothing. And then there is the third layer, and this is the part almost nobody is talking about. If stablecoins are government money and blockchains are the pipes, what's the collateral? In the old financial world, that's treasuries, gold, sovereign debt. But in the decentralized digital economy, where agents transact across borders 24 hours a day with no central bank, you need a neutral, non-sovereign reserve asset, and that's the role Bitcoin might play. JP Morgan is already accepting Bitcoin as collateral. Over 170 publicly traded companies hold it on their balance sheet. Now, how do you actually position around this? Circle is the obvious name, but after 100% move in 5 days, chasing it here is a bit risky. I'd want to see a pullback before building a position. Bitcoin and major crypto protocols are a different story. They're down big from the highs. Bitcoin is off more than 50% from its October peak. And yet, this week, while the S&P crashed and gold sold off, Bitcoin held the 66 to 70k range. And this morning broke above 71k. That kind of relative strength during a war and forced liquidation event is worth paying attention to. If you believe in the long-term thesis we just laid out, this is a reasonable area to start building. This is why actually we cover crypto on this channel, not for price targets, not for hype, because the intersection of AI and crypto is where the next financial system is actually being built. While everyone is watching Bitcoin price and arguing about the bull versus bear, the real story is the plumbing going in underneath. Visa, Mastercard, Circle, Stripe, they're all building for a world where agents are the primary economic actors. The old system is cracking. New infrastructure is replacing it. It's not a prediction. It is happening. Okay guys, that's it for today. 3 takeaways. 1. Iran is playing out. Keep dry powder. Oil has likely made most of its move unless Hormuz stays closed for weeks. 2. The real story is the deleveraging underneath. AI disruption is cracking the financial structures built on old assumptions. Iran was the accelerant, not the cause. If the market drops 15 to 20%, that's when it gets interesting. We're not there yet. 3. The agentic economy is being built right now. Stablecoins are the currency. Blockchains are the rails. Bitcoin might be the collateral. Cycle doubling while everything else crashes tells you where the next cycle of value creation is. Crypto protocols are down more than 50% from highs. If you believe in the thesis, start building a position. Drop a comment. I want to know what you think. Is this deleveraging the start of something bigger or a buying opportunity? See you next week.